Hello everyone, welcome to Energy Turtle. Today's our top story is the ongoing shifts and pressures in the long-term liquid natural gas, or LNG, market. As reported from the recent Asia LNG Strategy Conference in Singapore, there is a strong demand for long-term LNG contracts, but the landscape is increasingly competitive. The dramatic tightening of the global LNG supply was sparked by the rush of European LNG importers securing long-term contracts in response to Russia's invasion of Ukraine last year. This rush proved to be a blessing for producers such as Qatar and the US, which funded new projects and expansion plans from the windfall of high prices. However, these high prices, coupled with countries' decarbonization initiatives, have slightly stifled interest in new 20-year deals. According to Dinesh Kumar, Vice President of Trading at Gale Global Singapore, once the situation in Europe stabilizes, the demand for LNG is expected to come from Asia, especially South Asia and Southeast Asia. He stated that the recent drop in prices brings relief to the Asian market, particularly for buyers in Southeast Asia and India. Asian spot LNG prices have more than halved this year, with the Platts JKM dropping below the $10 per MMBTU level for June delivery, a significant dip from a peak of over $80 per MMBTU in March last year. India's spot LNG imports have decreased recently due to a surge in domestic gas production and the import of U.S. contracted volumes. Despite this, Kumar predicts that by 2030, India's LNG demand will hit 35 million MT per year. Currently, long-term contracts cover only 20 million MT per year, indicating a need for an additional 15 million MT per year of LNG. Kumar added, if we keep 20% on spot or short term, that leaves 8 to 9 million mount per year of additional volume to be contracted. This presents a ripe opportunity for LNG sellers and a considerable interest from Indian buyers. Despite the high premiums that suppliers are asking for long-term contracts starting in 2024-25, Indian buyers are trying to develop a solution that caters to immediate needs and offers affordable prices for the long term. In terms of Asian attitudes towards LNG contracts, Shun-Ling Yap, Principal Analyst, LNG Marketing at Mexico Pacific, says that most buyers, excluding Japan, are still willing to secure 20-year contracts. In fact, even Japan, with its aggressive ammonia and hydrogen targets, has advocated for gas investments at the G7. The Chinese market, in particular, has shown heightened interest in securing long-term supply deals. But it's not just about prices. Yap and Kumar emphasized that the reliability of the contract and the commitment of the producer to supply the needed LNG in a tight spot market is also crucial. One aspect under heavy scrutiny is the willful default clause, which refers to a situation where an LNG supplier decides to sell a term cargo in the spot market at a higher price and pays a penalty to the term customer. Previously, the penalty for supply or pay was just 50% of the contract, but this is now being revised to 100%. Despite fierce competition, Yap affirmed, there is still a market, and it's really up to us as producers to optimize the sweet spot between market demand, rising interest rates, and rising construction costs. Next is the upcoming G7 summit in Hiroshima, Japan, where the group's leaders are expected to enhance the enforcement of Russian sanctions and strengthen strategic commodities supply chains. This summit marks the second time the G7 has convened since Russia's invasion of Ukraine, a crisis that has put energy and critical mineral security at the forefront of the group's agenda. The conflict underscored the necessity for governments to bolster strategic commodities and materials supply chains, with Japan identifying natural gas, critical minerals, semiconductors, and storage batteries as critical materials for its economic security. The United States, under President Biden's administration, is advocating for more stringent sanctions against Russia. A senior administration official confirmed on May 19 that all G7 members are ready to enforce new sanctions and export controls, indicating the U.S. is preparing a substantial package to increase economic pressure on Russia. However, ambiguity looms over what steps the G7 could take to strengthen sanctions on Russian energy, considering the differences in members' energy mix and import dependencies. The United States and the European Union believe that price caps on seaborne exports of Russian crude oil and oil products could significantly impact Moscow's revenue and impede its war funding capabilities. According to a progress report by the U.S. Department of Treasury, Russia's federal oil revenues in the first quarter of 2023 dropped over 40% from the previous year's levels. The dwindling oil revenues occurred despite Russia exporting around 10% more crude oil in April 2023 compared to March 2022. Implemented in December 2022, G7 restrictions capped the shipping cost of Russian crude oil at $60 per b, aiming to maintain market supply while affecting the value of Russian oil exports. By February, these caps were expanded to include Russian oil products. Although Russia redirected most of its crude oil, previously imported by new customers in Asia, Africa, and the Middle East, IEA estimates Russia's oil export revenues fell by $2.7 billion to $11.6 billion in February, down 42% on the year. In addition to sanctions, G7 leaders will deliberate on varying strategies for climate goals and energy security, including the potential endorsement of the G7 Sapporo Climate and Energy Ministerial Agreements from April. These agreements underscored the need to end unabated coal-fired power generation and to phase out unabated fossil fuels by 2050 to maintain global average temperatures within 1.5 degrees Celsius above industrial levels. Furthermore, the G7 leaders are anticipated to accept a plan for enhancing critical mineral security as outlined by Energy and Environment Ministers in Sapporo. As part of their net zero economies efforts by 2050, G7 energy ministers have paid increasing attention to critical minerals, including lithium, nickel, and cobalt, which are crucial for batteries and electrification technologies. Thanks for watching.